Okay, so what we're looking at here isn't just another quarterly report from Berkshire Hathaway. Nope. This is basically the final blueprint from the Warren Buffett era, the last big strategic moves before the official handover. This single document, it's signaling the dawn of a whole new chapter for one of the world's most watched companies. And look, that's not me being dramatic. Analysts are calling this moment exactly that, a definitive turning point in the modern history of capital allocation. We are literally watching a historic shift happen in real time, and this filing, well, it's our first real map of this new territory. And this timeline really puts the scale of this whole thing into perspective, right? From 1965 all the way to the end of 2025, that's a 60-year run, an entire era. And now, on January 1st, 2026, the Able era has officially kicked off. So the big question is, what was Buffett's final message to the market, and what can we learn from his very last trades? All right, let's get right into the portfolio itself. By really digging into these final trades, we can start to see the exact strategy that Buffett is leaving behind for his successor.
You know, this table tells such a fascinating story. On the one hand, the buy side, we've got a brand new position in the New York Times, and they're bulking up on the energy giant Chevron and the insurer Chubb. But then you look at the sell side, a little trim to Apple, a massive, and I mean massive, 77% cut to Amazon, and a big reduction in Bank of America. The pattern here is crystal clear. But let's talk about the most surprising move of all, this one. A new $351 million stake in the New York Times. Now, why is that so shocking? Well, because just a few years ago, Buffett himself famously said that most newspapers were, and I quote, toast. This investment signals a huge strategic rethink. It seems they're no longer seeing a newspaper, but a global, digital subscription powerhouse. And when you put it all together, you really see the crucial pivot they're making. They are systematically selling off high-growth, high-multiple tech and finance stocks, and they're buying into defensive, value-oriented companies with really predictable cash flow. In short, it looks like they're battening down the hatches. So this strategy actually has a name. It's called the defensive pivot. It's all about lowering your exposure to those really volatile growth stocks and boosting your holdings in stable, cash-generating companies. It's a classic move, really, to protect a portfolio against economic uncertainty. And it's sending a powerful signal about how Berkshire sees the market heading into 2026. But the portfolio moves, that's only half the story. The other half, and you could argue it's the bigger story, is the absolute mountain of cash that Berkshire is sitting on. And this isn't just money in the bank. This is a strategic weapon. Just look at that number, over $381 billion. Let that sink in for a second. That is the size of the war chest Berkshire is holding in cash and short-term treasuries. It's an almost unimaginable amount of firepower. And this chart really puts that number in context. A staggering 31.1%, nearly a third of Berkshire Hathaway's total assets are now in cash and treasuries. To put that another way, they have more money just sitting in liquid reserves than they do in their entire public stock portfolio combined. Wow. So why are they holding this much cash? Well, it's a very deliberate choice. First, they've said they can't find any big companies to buy at prices they think are attractive. Second, it's that defensive posture we talked about again. But maybe most importantly, it gives the new CEO, Greg Abel, maximum optionality, the freedom and firepower to make his own mark. And hey, it doesn't hurt that it's generating over $3 billion in interest every single quarter. But you know, these changes aren't just happening on the balance sheet. At the exact same time, there's a pretty significant reshaping of the leadership team itself going on. And the biggest surprise on the leadership front had to be this: the departure of Todd Combs. As one of Buffett's two handpicked investment managers and the CEO of Geico, he was widely seen as a future leader of the entire firm. So his sudden move to JP Morgan, yeah, that sent some serious shockwaves through the investment community. So Combs' departure set off a kind of chain reaction. Nancy Pierce, a 40-year company veteran, stepped up to lead Geico. Other execs took on more responsibilities, and a clear succession plan for the CFO was announced. What this really shows is the firm is transitioning from a small group of iconic figures to a more traditional institutional corporate structure under Abel. So with a new portfolio strategy, a fortress of cash, and a new leadership team in place, what does the future actually hold? Well, the filings give us some pretty intriguing clues about Berkshire's next act. So what could be next? Analysts are speculating on a few key moves. First, will they finally get out of that long underperforming Kraft Heinz investment? Second, will they lean into more toll bridge tech companies like Google?
And, of course, the elephant in the room, what massive acquisition are they finally going to make with that enormous pile of cash? You know, the first real test for the new CEO, Greg Abel, is already on the calendar, the annual meeting on May 2nd, 2026. For the very first time, the global spotlight is going to be entirely on him, and he'll have to lay out his vision. This is the moment the Abel era truly begins in the public eye. Which brings us to the final crucial question. Warren Buffett has set the stage perfectly. He's handed his successor a de-risked portfolio and the largest corporate war chest in history. So, with a new CEO at the helm and a $382 billion war chest, what is the first big move of the Abel era? That's the multi-billion-dollar question everyone is waiting to see answered.